Okay, a few people are having trouble with that quiz regarding a direct issuance, the elimination entries or consolidation entries for a direct issuance. So I want to go ahead and run through a quick example. And I've noticed that, I would try to, the quiz I put up, I use straight line amortization trying to keep life simple, but apparently that threw off a number of people. I guess perhaps in the World Campus Intermediate 1 and 2, they only cover effective interest amortization. So you need to know both of these things. So let's go ahead and do an example under straight line amortization. So let's say that let's assume big owns 70% of little co stock. Let's assume that on January 1st, 22, big issues $100,000 of 10% 10-year bonds to little for $96,000. Interest paid, this is irrelevant, but I just like to have it in there. Interest paid annually each December 31st. Okay, so again, this is what's called a direct issuance, where the bonds are sold directly from one party to the related party. From a consolidated standpoint, these bonds don't exist and they never have existed. Basically, what this amounts to, if we view big and little as a single combined entity, then basically the entity has loaned money to itself by issuing bonds. So we need to make these bonds go away. First, the amortization. Again, straight line amortization, we've got a $4,000 discount amortized over the life of the bonds at $400 per year. Okay, now think about what happens on the books of Big and Little when they do this. Okay, so on Big's books, they're the ones who are going to be issuing the bonds, so they're going to take in $96,000 in cash. They're going to have bonds payable at face value, and the difference is that discount on bonds in the amount of $4,000. On Little's books, they're the ones who are buying the bonds. So they're going to have investment in bonds for the price they paid for them, and they write a check for $96,000. Okay, so this is what Big and Little did when this transaction took place. What happened over the course of the year? Well, we're going to use straight line amortization. So at the end of the first year, at the end of 2022, Big Company is going to record interest expense. And, there are two ways we can do this. I've always just sort of by reflex done the coupon interest and the amortization separately when using straight line amortization. Obviously, for the effective interest method, you have to do them as a single entry. But I'll do this as two separate entries. So we're going to have the coupon interest, 10% of $100,000. And then we have the amortization. And again, basically what we're doing is we're chipping away at this discount at the rate of $400 per year. So we're going to go ahead and credit the discount on bonds and debit interest expense. Okay, over on Little's books, they're going to be the ones who are receiving the interest. So they're going to take in $10,000 in cash, and that's going to be their interest revenue. And they too need to amortize. There's a discount that's generally the bond buyer doesn't record a separate discount or premium. They simply record the investment at its cost. And then what they're going to do is by the time these bonds mature, this investment needs to be up to $100,000. And so what we're going to do is we're going to amortize that $4,000 discount by increasing the investment in the investment in bonds, and crediting interest revenue for $400 every year for the next 10 years. So when we do the consolidation entry or the elimination entry, basically, from a consolidated standpoint, these bonds don't exist. We have to remove all evidence of this bond relationship from our books. So the single best and safest and most useful thing you can do is make up a shopping list of what accounts are on the ledgers of Big and Little related to this bond issue. So what does Big have? Big has bonds payable of $100,000. They've got a discount on bonds of, okay, so again, if you want to make up a T account, you should do that. But basically the discount, $4,000 minus $400 that was amortized, so the discount is down to $3,600. And they've got interest expense of, again, $10,000 plus $400 is $10,400. Little has the exact opposite. They have a bond investment or investment in bonds. And again, look at their bond investment. They started at $96,000. They added $400, so they are up to $96,400. Again, the nice thing about these constructive retirements is basically the two books are mirror images. The borrower, Big, has a liability of $96,400, the face value minus a discount. The buyer has a bond investment of $96,400. Similarly, interest revenue, $10,000 plus $400, $10,400. So again, we have a mirror image where the borrower has interest expense, the lender has interest revenue. Again, basically, we need to make it appear as though, basically, we need to get rid of these accounts. From a consolidated standpoint, these bonds don't exist. We got to get rid of all this stuff. So now it's simply a matter of going through and saying, how do I get rid of these? Well, bonds payable is a credit account, so I'm going to debit bonds payable to get rid of it. Discount on bonds is a debit account, so I'm going to credit discount on bonds. Interest expense is a debit account, so I'm going to credit interest expense. Again, all I'm doing is I'm going down the list of accounts, getting rid of them. If they've got a debit balance, I credit them. If they've got a credit balance, I debit them. Over here, the investment in bonds has a debit balance, so to get rid of that, I'm going to credit it. Interest revenue has a credit balance, so to get rid of that, I'm going to debit it. Okay, because again, basically, these things are mirror images, whereas Big has a liability and an expense, Little has an asset and a revenue. Notice that this entry has no effect on income. Basically, these bonds, from a consolidated standpoint, these bonds never existed. So what we're doing is we're getting rid of $10,400 of revenue, we're getting rid of $10,400 of expense. This has no effect on income. Now let's go ahead and go through to the following year. And again, since we're using, again, the reason I use straight line amortization is because it takes one issue of sort of complexity out of this. Because I want to focus on the bond relationship. In 12/31/23, I'm just going to copy this. In 12/31/23, the entries would be the same. Again, another $10,000 in coupon interest, another $400 in amortization. But think about how the accounts are changing. Now again, straight line amortization makes life nice and simple. Bonds payable, still $10,000. The discount is being amortized at the rate of $400 per year. It started at $4,000. By the end of the first year, it was down to $3,600. Now it's down to $3,200. Interest expense is still $10,400 under straight line amortization. Likewise, over on Little's books, their investment in bonds started at $96,000, and we're adding $400 to that every period through this amortization. So at the end of the second year, the investment in bonds is up to $96,800, and the interest revenue is still $10,400. So the only thing that's changing is the discount is dropping by $400 every year, and the investment in bonds is rising by $400 every year. So basically, this becomes $3,200, this becomes $96,800. And it will be the exact same process each and every year until this is all completed. In fact, if we go ahead to the 10th and final year, I'm not going to, well, what year would that be? Okay, so I'm going to get my dirty little secret here. I'm going to count on my fingers. So these things were issued at the beginning of 2022. So 22, 23, 24, 25, 26, 27, 28, 29, 30, 31. So 12, 31, 31. We would do this exact same entry again. Again, every year it's the same thing. $10,000 of coupon interest, $400 of amortization. But by the end of the 10th year, the discount has been entirely eliminated. Again, the whole point of, not the whole point, but part of the point of the amortization is to get rid of the discount or premium. So the discount is down to zero, and the bond investment would be up to $100,000. So for the final year, our elimination entry, assuming these things, we can pretend these things are going to be paid off on January 1st, so the next morning. But by the end of the year, the entire discount has been gotten rid of, and the bond investment is up to $100,000. Again, this entry still balances. There's nowhere in this entire process has there been any net effect on income. Each year, the amount of interest revenue exactly equals the amount of interest expenses being eliminated. So there's no effect on consolidated net income. It doesn't matter whether it's upstream or downstream. Basically, all we're doing is we have two sets of books. One set of books has a liability and an expense. The other set of books has an asset and a revenue. Hold on. Hi there. I'm fine. How are you? Hold on. Let me pause this.